Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik. Welcome to episode 26 of my Dow analysis series. In this video, we'll be analyzing the sixth largest company in the Dow by market cap, which is Walmart Inc., ticker symbol WMT. Walmart splits their business into three basic segments. So they have Walmart US, Walmart International, and then Sam's Club. The Walmart US segment operates in all 50 states, Washington, D.C., and Puerto Rico, and this segment generated about $393 billion of net sales in fiscal year 2022, which represents about 69% of Walmart's net sales. Walmart US has historically had the highest gross profit rate among the three segments. Walmart International operates in about 23 countries outside of the US, many of them which are in Africa and South America, which was a bit surprising to me. And also, another interesting fact about Walmart International, they recently sold Walmart Argentina in fiscal year 2021 and Walmart UK and Japan in fiscal year 2022. So in fiscal 2022, Walmart International had net sales of around $101 billion, which represented 18% of the company's total revenue. The final segment, the Sam's Club segment, operates in 44 states and Puerto Rico, and they are a membership-only store, and in fiscal 2022, they had net sales of $73.6 billion, which represented 13% of the company's revenue. Walmart's fiscal year actually runs from February 1st to January 31st, so the second quarter for fiscal year 2023 ended on July 31st of this past year, and they reported those earnings on August 16th. Total revenue for the quarter was $152.9 billion, which was up 8.4% year over year, which was really awesome to see. And then net income for the quarter was $5.1 billion, which was a 20.4% increase from the second quarter of fiscal year 2022. Another great thing for the quarter is that shares outstanding decreased by about 2.3% year over year. This means that shareholders now own a larger portion of the business, which is awesome to see. Better yet, Walmart has a great track record of buying back shares. They have bought back about 25% of outstanding shares since 2010. Walmart did reiterate some of their guidance for the full fiscal year 2023, and they are expecting about a 5% increase in revenue throughout the whole year, and they are expecting about a 10% decrease in earnings per share versus 2022. So overall, that isn't super promising, but shipping costs have definitely gone up a lot this year, which could be part of the reason for that guidance. The first thing I see when looking at the balance sheet here is the large decrease in cash and increase in inventories over the past year. This totally makes sense to me. Supply chain issues have continued to escalate, and it now pays to have the inventory in hand. Adding inflation to that mix, it pays to have less cash as well. In total, Walmart has $84 billion of current assets, which is up about $6 billion from a year ago. This is actually below their current liabilities of almost $100 billion. Current liabilities are up a lot since last year, and the main increases are from short-term debt and long-term debt that is due within a year. This is definitely not a good sign to see, but when we look at long-term debt, this is down substantially, about $10 billion lower than last year. So because of that, the short-term increase in current liabilities doesn't seem to be an issue to me, at least in the short term. The other big thing that I do notice is that Walmart has no treasury stock on their balance sheet. So although they do buy back lots of stock, they don't keep the shares in treasury, they actually cancel them. So this gives them a great shareholders' equity of around $77.6 billion and a return on equity of about 18%, which is pretty solid. Overall, I think the balance sheet is pretty healthy, but my big concern is short-term borrowings. But if we look back in a few quarters and those short-term borrowings have decreased substantially from where they are now, then that likely won't be an issue at that point. Now looking at Walmart's dividend, the first thing that I see is that it's relatively low at around a 1.6% yield. The low yield is rewarded with a very safe payout ratio of around 37%. However, Walmart hasn't been growing the dividend very quickly at all. Over the past 5 years, they've raised the dividend less than 2% on average. This makes Walmart pretty unattractive to me from a dividend perspective. I'm totally fine owning companies that have a low starting yield if they have solid dividend growth. And likewise, I'm very happy owning companies with higher starting yields but lower dividend growth. However, in the case of Walmart, I'm not really interested in owning a company if it's primarily a dividend investment, at least, if they have a low yield and a low rate of growing that dividend. Even though the dividend growth rate is pretty low, they do have a great track record of increasing the dividend with 48 consecutive years of dividend growth. They are pretty close to becoming a dividend king. So the consistency of dividend growth is certainly there. It's just not the magnitude of growth that I would like to see. Starting to look at valuation now, the first metric we're going to take a look at is the PE ratio, which for Walmart is sitting at about 27 right now. This is about 50% above their historical averages, which have been around 18 over the past 10 years, as we can see here. So it looks like Walmart could be a decent bit overvalued. Part of the driver of this high PE ratio is minimum earnings growth. Over the past 10 years, as we can see right here, Walmart's earnings per share have grown from about $3.19 per share in mid-2009 to about $5.01 per share in mid-2022, which is only a compound annual growth rate of about 3.5%, which is not very good at all. When we look more broadly, the PE ratio of the S&P 500 is right around 20, and that is also about the PE ratio of the consumer defensive sector right now, which Walmart is a part of. If we go down a little bit deeper, the PE ratio of the retail defensive industry, which is within the consumer defensive sector, is also around 20. So when looking at the broad market and at Walmart's peers, they certainly appear to be overvalued from a PE ratio perspective. The DCF model doesn't look much better for Walmart. When I did my calculation, I got a fair value of $90.44, and applying a 10% margin of safety gives us a buy price of $81.40. When we compare this to their current price of around $141, like I said, this doesn't look very good at all for Walmart. They certainly look to be overvalued a fair bit. Looking now at a 3-year chart of Walmart, we can see they have this pretty nice support line here that encapsulates both the March 2020 lows and a low they had in February of 2022. However, they recently blew through that support and have since kind of meandered up back to it. So there's a chance that that support could actually act as a resistance going forward. We'll just have to see. But if the stock price can break above this line, then it could act as support again as well. A promising sign I see also is that the stock is now above the 50 and 200-day moving averages, which are certainly bullish signs. And the stock right now is in the range of 140, like I said, which is the range that the stock has had the most volume over the past 3 years, as indicated by these blue bar charts on the right side here. So I think right around 140 is a pretty solid level for the chart, and it could be an area of consolidation over the next few months, or at least not much movement of stock price. I remember I did do a few options trades on Walmart towards the beginning of the year, and it was when the stock was around the $140 range in general, and in that range they seem to kind of oscillate up and down a little bit, but with the exception of the past few months, they generally stayed in the $130 to $150 range during that time period. From a qualitative perspective, I think Walmart is a pretty solid company. They seem to have a pretty nice competitive advantage in terms of their low prices and customer loyalty. They really have the customer's trust that the customer is getting the best deal around, and this is a powerful attribute for sure, but it isn't strong enough for me to buy Walmart. First of all, the dividend yield and growth rate are both low, which is a bad sign for me. This makes my mindset shift a little bit to look at Walmart from less of a dividend perspective and more from a fundamental valuation perspective. And from this perspective, again, Walmart definitely looks overvalued and unattractive from looking at the PE ratio and discounted cash flow calculations. So I will certainly not be buying Walmart at this point, but I would love to hear your thoughts on the stock in the comments down below, and let me know what you think the fair value is. If you missed my last Dow analysis video, make sure to check out this video right up here that I made on JP Morgan stock, in which I went over their recent earnings report. Thanks for watching, and I'll see you all in the next one.